Ladies and gentlemen, good day and welcome to the PDS Limited Q4 FY22 earnings conference call hosted by Edelweiss Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star and then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandeep Agarwal from Edelweiss Securities. Thank you, and over to you, sir.
Thank you, Enba. Good morning, good afternoon, good evening, based on different time zones for people who are joining us for the call. On behalf of Edelweiss, I would like to welcome you all to the Q4 FY22 and full year 2022 earnings call of PDS Limited. From the management today, we have Sanjay Jain, Group CEO, Mr. Ashish Gupta, Group CFO, Reena Joseph, Head Corporate Finance, M&A and Investor Relations. I would now like to hand over the call to Mr. Sanjay Jain for his opening remarks. Over to you, Sanjay.
Thank you, Sandeep. A very good morning, afternoon and evening to all of you. Welcome to our Q4 FY22 and full year 21-22 earnings call. To begin with, we are excited to share some important highlights for this year. Firstly, PDS has crossed the $1 billion top line for this fiscal year. And secondly, our manufacturing segment has turned profitable in Q4 of the financial year and therefore making a meaningful contribution to the consolidated part of the company. The numbers that I'm going to mention in the opening remarks would be in rupees crores, but for the convenience of our investors from the international arena, in the investor presentation, wherever possible, we have tried to give them in USD equivalent as well. So in financial year 2021-22, we reported a 42% growth with top line of 8,828 crores versus 6,213 crore last year. With gross margin steady at 16.2, we reported EBITDA of 323 crores with a 3.7% operating margin. This translated into a 40% growth versus 230 crore EBITDA in the previous year. The EBIT at the same time increased by 70% this year to 339 crores versus 200 crore last year. Because of the sales growth, because of the EBIT expansion, the profit after tax of the company increased by 97% at 293 crore this year versus 148 crore last year. The PAT margins expanded from 2.4% last year to 3.3% this year. The above growth and profitability were achieved amidst the apparel industry facing headwinds from the macro factors, including the increasing input cost, freight cost, and supply chain disruptions in various parts of the world. While earlier this year was disrupted by COVID, the situation was further affected by the Russian-Ukraine conflict and very of late the Sri Lankan turmoil. While with not at all any presence in the Russian and Ukraine countries, this had a very limited direct impact on PDS since we don't have any meaningful operations there. However, this Russian and Ukraine situation had a rub-off effect across the EU region, increasing the fuel, freight, and inflations thereof. If we talk of Sri Lanka, it at present contributes to approximately 7% of the total consolidated top line of the company. We are closely monitoring the situation, given that the banking lines for our Sri Lankan operations are from Hong Kong. At present, our operations largely remain unaffected, and at present, the operations running smooth there. We're keeping a close watch, but for now, the impact is minimal on our operations. On our sourcing segment, which accounts for 96% of our top line, it clocked 40% growth as compared to last year, and our sourcing business reported an EBIT of 311 crore and an ROC of 43% as compared to 302 crores of EBIT last year. So a 40% growth in the sourcing segment and an ROC of 43%. Our manufacturing segment reported a growth of 92% in the annual top line, and we achieved 547 crore this year. Further, on a full year basis, the PBT losses declined by 80% from 104 crore in 2021 to 19 crore last year. And our sincere efforts that we have been putting over more than a year, 12 to 15 months, have started showing results. And in Q4 of last year, the business actually made PBT margins of 3.1% as compared to a loss of 11.8% to sales in the Q4 of the previous year. With our enhanced focus on running full capacity, deriving efficiencies, disciplined execution, we are positive and aiming to achieve 5% PBT to sales over the next 2 years in our manufacturing facilities. In the last financial year, the company reported EBITDA margin of 3.7%, which were largely same as last year. However, as we reflect on this, some of the following points need some consideration. The EBITDA this year is after an impact of 44 crore investment, which is a debit to the profit and loss account this year. That was our investment into new businesses. The EBITDA this year is also after an impact of ESOP cost of 22 crores, and there was nil ESOP cost in the corresponding period of last year. The third important factor is, during this year, our sales to US markets increased from 8% of our top line in financial year 21 to approximately 16% in FY22. And around 75% of these sales in FY22 were based on LDP, landed duty paid, which have an element of freight cost. Due to this, our freight cost increased by more than 200% in terms of absolute terms as compared to last year. It was about 25 crore in FY21, and now it is 82 crores in FY22. This was our first major year of increasing our efforts to derive maximum sales out of US markets, and now we are increasingly focusing more on doing business with US on FOB basis rather than LDP basis. The fourth important factor that is important to consider, that in FY21, we had a large share of PPE business, which contributed about 487 crore of top line in FY21 and about 69 crores of EBITDA in FY21. And current year, it is a negligible business. So to summarize, the EBITDA this year is after a one-off impact of ESOP cost, it after 44 crores of investment into new businesses, and is reflecting after increase in the freight cost. If we try and add back the ESOP cost of 23 crores, if we try and add back the freight cost, if we try and add back the new business losses, and from the last year, if we take out the PPE profits, then our EBITDA margin this year would actually be about 5.5%. So therefore, what appears to be 3.7% last year, 3.7% this year, after adjusting for PPE and all these one-time factors, the last year number would look at 3.4%, and this year number would look at 5.5% or so. And allow me to add here, as we shared in our previous investor releases as well, that the investment that we are making into new businesses, which in a normal scenario one invests into capex through the balance sheet, they start yielding results over a 3, 4, 5-year horizon. In our case, it is an expense that goes through P&L. But the potential, as we shared with you as part of our last investor release previous quarter, is that we have a potential of deriving $300 million of sales over 3, 4 years from this investment into new verticals and about 4% of PBT. And I'm pleased to share with you that with the year that have just commenced, we believe we should be getting closer to about 500 crore plus in terms of top line from the new businesses as the contribution to this year top line, and we aim to achieve a PBT break-even from the new investment we are making. So therefore, in summary, the point I'm making is that there is a sustainable closer to 5%, little above that EBITDA that we have achieved in FY22 if we do a normalized position. While I've highlighted the benefit or the rationale of the 44 crore that has gone into new businesses, the ESOP cost that we have incurred, we believe is a decision that has been taken by a company in terms of retention of the talent, and more importantly, PDS, as you know, is an aggregation of verticals, and through the ESOPs, we have also tried to align the interest of the leadership team at the vertical level with the overall value creation agenda which is being pursued at the PDS level. As a platform, we've also been playing a lot of importance on stringent risk management and have been trying to constantly put some mechanism in place. And as a result of this, as a result of the operating efficiencies that we have been aiming at, I'm pleased to share with you that we have achieved a negative working capital of -3 days on FY22 March, ended FY22 versus 5 days at the same position in the corresponding previous year. So we've actually achieved a delta of 8 days over the 2 financial years. And on one hand, we have achieved a 40% plus growth rate over the year, but our net debt has actually reduced from about 59 crore last year on March 21 to a net cash position. When I say net cash, it is cash and bank balance in hand less the borrowings. The net cash position is about 41 crores. So there is a delta of about 100 crores between March 21 to March 22. This relative squeeze on the capital employed, especially on the working capital, plus the earnings growth, have translated into the company achieving a return on capital employed on the net capital of 38% and return on equity of 31%. I believe we have put in efforts and ended the FY22 on a positive note. In line with our dividend distribution policy that was adopted earlier last year, the board has recommended to the shareholders to consider a dividend of rupees 23.85 per share, which translates to 238% of the face value, and it is 25% payout of the earning per share. So the last year dividend was 15.75 rupees per share. So there is a 51% growth year over year in terms of dividend per share. Allow me to also clarify, when we talk about 25% payout, from the consolidated PAT of the company, we have reduced the minority share and arrived at the PAT, which is the PAT attributable to the public market shareholders, and it is on that PAT that the board has considered a 25% payout and recommended to the shareholders. As a global platform, now we are aspiring to aim and achieve closer to $2.5 billion of annual business that we aim to handle in about 5 years from now, which in a way translates to an average 15% growth that we believe we would like to target, that this should be the annual volume that we would handle in a year, in 5 years from now. We believe we have a strong ecosystem already in place, and we have identified key areas to focus our platform and further strengthen it. On one hand, as the organization is gearing up to handle this kind of annual business volume, we're also trying to strengthen the platform that supports the verticals to achieve this top line. And we believe we have built strong capabilities and have a good pipeline of opportunities, both organic and strategic. If you may kindly recall, we had earlier mentioned that we have signed up a strategic sourcing arrangement with S. Oliver of Germany and with Haynes of US. And if I put both these together, there is a potential that on an annualized basis, these two strategic transactions should enable PDS handle a business volume of $450 million. Likewise, we have similar such engagements in place with reputed and large retailers, and we are positive that all these efforts and engagement can translate to a similar volume of annual business getting added in a reasonable time frame. So all put together, the two strategic sourcing arrangements that we have tied up, plus the funnel, should enable company get to about $800 to $900 million of annual business volume that we would aim to handle as part of the strategic sourcing for our customers. We are at the same time treading cautiously and carefully with respect to the macro and micro factors that are around all of us and could have an impact on the value chain. But on the whole, we remain positive in terms of this year ahead of us and the next 4 to 5 year horizon. At this stage, I'll be happy to have any questions and answer them. If anybody have any questions, please.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Prabodh Dasari from Tattva Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. So just wanted to understand the reason for the low tax rate of a company. And the second question is on the demand scenario. How do you see the demand playing out in the future? I mean, do you witness any reduction in demand because of higher cotton prices or so? Yeah, thanks.
Yeah, I think on the first one, the company has a global footprint in place. This is the global supply chain that we manage, and also keeping in mind the substance requirement in the place of effective management. We have operations run out of Hong Kong. A decent part of that is under the offshore tax regime, which enjoys concessional benefits. We also have a strong substance banking limits team handling our customers in the UAE part of the region, and that also has nil or concessional tax regime in place. So therefore, an optimization through the, as you know, PDS has 50 offices across 22 countries. So due to this optimum presence across these jurisdictions, mainly Hong Kong and UAE, it has resulted into the overall effective tax rate of the company coming down. That's the response to your first question. On the second one, I think, as I said in the opening remarks, because of the geopolitical situation, some of the macro factors, there is high inflation. There is a bit of turbulence in the EU region. So in the near term, one may see the retailers and customers trying to understand the impact and therefore exercise a little bit restraint coping up with whatever is happening. But for now, our order books are strong for this quarter and next quarter as well. So we believe, as we have been maintaining a 12 to 15% overall aspiration to achieve for this year, we should be good. So to summarize, there are some immediate terms, kind of anxieties around, but over the entire year, we do not see much challenges. And I think you also asked specific to the cotton prices. Yes, the input prices have been on a rise, but we believe they should be stabilizing soon. And our margins that are there at present, we've tried to factor in those cost increases. So we remain positive that for the entire year, 12 to 15% top line should be okay for us.
Sure. Just to follow up on the first question, so is there a timeline till which we'll have these tax benefits, or is it open-ended as of now?
For example, Hong Kong has an established offshore tax regime, and there are no time limitations to this regime in place. So that exists, number one. On UAE, at present, there is a nil taxation, but we believe because of the global tie-ups and treaties, there is gradual introduction of about 10% tax rate in about 2 years or so. So that's the timeline with respect to UAE, but otherwise, there are no limitations per se of the concessional tax benefit that is available to us.
Sure. Thank you, and all. That's all from me.
Thank you. We'll take a next question from the line of Riken Gopani from Capri Global. Please go ahead.
Yeah. Thank you so much for the opportunity. First of all, I would like to understand a little bit on the revenue front. Is the growth primarily coming from the new contracts? But and I'm specifically focusing on the fourth quarter. Are the new contracts driving growth, or is it being driven more by organic, and the new ones are yet to kick into the business? If you could throw some light on the growth in the fourth quarter.
See, if the new contract implies the S. Oliver strategic sourcing arrangement and Haynes, then the Haynes arrangement would start making a meaningful contribution only from quarter one of this year. The last year did not have, it only got into shape by the end of the financial year, then setting up of the office. So office is operational, team is up and running, so business is now slowly gaining momentum. So that's on contribution of Haynes. On S. Oliver, it did start contributing, and I think the approximate amount that got, it's about $10 million, circa that number, about 70 to 80 crore from the S. Oliver arrangement in the last financial year. So therefore, the growth that we have witnessed is mainly the organic growth in terms of doing more business with our existing customers, to some extent adding new customers as well. And also our manufacturing segment contributed 547, and it was almost like double, 92% growth over last year. That's where the growth is coming from.
Understood. Just a follow-up on the revenue piece. If I look at the geographic breakup that you have given, it does reflect that you witnessed a sharp growth in the European geography in Q4. I think it's more than 20% kind of a growth. Correct me if I'm wrong. Is it being driven by the pricing changes given the way how commodities are globally panning out, or is it being driven by volumes? Could you throw some more color? Is it being driven by opening up, or what's driving this kind of a strong growth in Europe and the UK?
The growth is largely driven by volume at present. Then actually, of course, there is always an element of price increase. But I think there is, while the translation of the efforts to growth you are witnessing in quarter four, but there's some structural changes that have happened in the preceding few quarters is that a lot of these small and medium factories or mid-size, which were either trying to cater to the UK and EU markets, have come under pressure during COVID times, be it the availability of banking lines, be it them able to meet the compliance requirements. And PDS at the same time in a tough COVID year emerged far more stronger. So as the retail customer post-COVID is trying to look at more credible counterparties in terms of sourcing requirements, that's where PDS is also starting to win more business from the customers. So that's the reason of this increase that has happened in terms of the growth traction that we achieved.
Understood. So in that context, given that you're seeing a reasonably strong traction in your core geographies, plus the new orders will now ramp up. In that context, is the 12 to 15% more driven by the current uncertainties in terms of the growth guidance? If you could sort of throw some light on that.
If I get your question right, while we have achieved 40% plus growth rate, but at the same time I mentioned about 12 to 15%, I think we would internally aim to do more. But at the same time, we all are witnessing the geopolitical situation that is happening around the world. We all are witnessing the high inflationary trends. So as a result, there is a bit of caution in our estimation for the entire year. Our engagement with customers is robust. Our order book is robust. So, but I think we will keep an eye on as situation unfolds by the half of the year. But at this stage, allow us to be a bit cautious in terms of the ecosystem around us.
Understood. That clarifies the point. The next question that I had was on the current inflationary scenario and how it influences our operations. It would require a lot of maybe price increases given how raw materials are moving. You've alluded to in your presentation as well. So do these inflations have any particular influence on your operating performance? Are your revenues as a percentage of the sourcing values? If so, in that case, will it help your operating performance actually, or could you clarify on these pieces?
So I think the input price that have gone up, typically our contract, while our arrangements with our existing large customer are stable, built over many years of relationship, but typically for the seasons ahead, there is a discussion that happens on the design, samples, volumes, and the prices thereof. So therefore, both the parties get to sit down, understand the input prices, and accordingly factor them into the new contracts that get shaped up at least for the next 2 quarters or so. And in the immediate preceding Q4, there has been an impact of the input prices on us in terms of our margins. But at the same time, PDS is today a $1.2 billion if I just do an approximate top line and about 16% gross margin. There is a huge amount of cost of goods sold, and there is a lot of scope on fabric as well as trim procurement and deriving the volume and the price benefit because of the volume procurement. So we believe we are hastening up our initiatives on that front, and that should allow us to combat the prices impact because of the purchasing price benefits. That is number one. We also, as you may see from our investor presentation, we have a licensed brand business, Poetic Brands, run out of UK, which at present is about $32 million in top line, doing closer to 50% gross margin. That business kind of went ahead and did a small acquisition of a company in UK. That brand that we have licensed brand we've acquired is going to help us gain more traction on the gross margin as well. So that's the direction we are taking. Plus, we talked about the high margin categories that we touched upon last time in terms of the accessories. So slow migration, gradual migration to adding high margin category, the benefit of the procurement synergies on a larger volume, the manufacturing contributing more. Just to add, manufacturing on an average make about 35% gross margin. And fourth point is that very humbly, PDS is, with every quarter passing by, gaining a position of strength vis-a-vis positioning itself before the customer as a credible, stable, and compliant partner, in terms of compliance and financial stability. And that, therefore, will bring in our additional ability to sit down and discuss with the customer and, kind of mitigate the impact of margins. That's the 3-4 dynamics that is under play. But for the immediate future, this quarter and next quarter, I think the benefit of these initiatives that I spoke to you, they would translate into results more in quarter 3, quarter 4 than actually in the immediate near term.
Understood, sir. That was very helpful. Thank you so much. Just one last question before I join the queue back is on the investments in ventures that you do. What would be the guidance for the next year?
We firstly, before I talk about any guidance in terms of numbers, I think what is important is the synergistic impact of these venture tech investments, which are, for example, say a D2C brand, or investing into some technologies which are focused on the sustainability agenda in terms of minimizing the impact of the apparel value chain on the ecosystem. And these investments, on one hand, are a contribution that PDS is making to the ecosystem. But these investments are also an important consideration when a customer is looking at strengthening the relationship, or PDS is looking at strengthening the relationship with the customer, wherein we are seen as a very responsible corporate citizen in terms of impact. So therefore, these investments not only have a financial angle to it in terms of the return they can make, they also have an important correlation with the business we do. That is the rationale. Now, to answer your question, at present, about 19% of the gross capital employed of the company on March 22 has gone into the others segment. We have tried to give a breakup of 7% treasury, 3% real estate, and about 9% into venture tech. Now, allow me to answer your question. We believe over the next 2-3 years, as we gradually move ahead, we should be in the range of about 6-7% of the gross capital employed of the company, which at present is about 9%. We believe in about a year or two. In fact, in our investor release, we have tried to mention that there is about a 5 crore rupees gain that has happened in this part, 9%, but we have taken it in the balance sheet OCI rather than the P&L. So we believe in a year or two, we should start. We are hoping to get some realizations. As a result, to some extent, it will be self-fulfilling. So therefore, to specifically answer your question, about 6-7% of the gross capital employed is what we are looking at as a maintainable level of investments into venture tech.
Thank you so much, sir, for all the answers, and all the best. Thank you.
Thank you.
Thank you. We'll take a next question from the line of Dhruv from Jairam Stock Brokers. Please go ahead.
Hi, thank you for taking my question. My first question would be, in the previous question, you just mentioned that only 6-7% of your of the capital employed will go into venture capital. But considering the company had such strong cash flows, Will PDS go a bit aggressive on that context, or they'll just go in for 4% in real estate, 4% in your government securities? So why isn't PDS, my question is, why isn't PDS being aggressive in the venture capital thing if the cash flows are that strong?
I think we do not intend to make any meaningful investment into real estate. If at all, you may kindly recall earlier in the first quarter in the last financial year, we monetized one of the real estates, and we would keep looking at opportunities to monetize during the current financial year as well. So we do not anticipate. I think our core business is sourcing. Our core business is manufacturing, and the surplus that we generate, we've also adopted a dividend distribution policy and trying to deliver up to that. And if at all we've chosen to invest, it is into treasury, which is into liquid and illiquid. So we would make a reasonable allocation to that. But venture tech is not a mainline activity of the company, but it is an important activity which has a strong synergistic impact on our mainline businesses. Plus, it is our contribution to the ecosystem, as I said, as a responsible citizen. So I think allow us to try and channelize our cash flows more for our mainline activities. And this is only the second year of dividend distribution. I think we want to continue to remain focused on steadily generating strong cash flows, and the ecosystem around us is also leading to a lot of opportunities that we could consider in terms of getting into our fold. As you know, we invest into new businesses, but there are some small ticket size opportunities. For example, we mentioned about Sunny Up that we have mentioned in our investor release. This company is doing about $0.4 million of EBITDA, and we have acquired the company at about $1.2 million, just about 3 times the EBITDA. These are small ticket opportunities that are around us as well. So we would, to summarize answer to your question, allow us to channelize cash flows, conserve cash flows more for the mainline activities, and allow us to carefully examine the opportunities that are unfolding in the ecosystem, which are synergistic to what we are doing, and then invest into them.
Okay, thank you. Thank you so much for the answer. And my second question is just a clarification. As per the business model, you had mentioned earlier also that PDS pays to its suppliers on a pay-as-we-get basis. So it means that PDS does not pay its creditors till the time it does not receive amount from its debtors. So I'm just trying to understand what happens if a particular debtor does not pay PDS. Does the onus of paying the creditor, is it on PDS, or the creditor will also have to write off its debt?
I think the opening sentence that you mentioned in your question is our intended objective as we conduct our business, try and have a neutral or a negative working capital. So what we aspire for is, can I conduct my business in a form and manner that I am not in a cash out situation wherein I need to pay my vendor ahead of the realization. So on very simplistically basis, this can be managed through managing the receivable and payable cycle, trying to match them. At the same time, any selection of a customer, onboarding of a customer is through a rigorous credit assessment process, and to a large extent, we get the benefit of non-recourse factoring that is available with our banks. So I get money faster, and in a reasonable time frame of few days, with the non-recourse factoring, the money is realized. And to that extent, basis the terms with the vendor, we try and use that cash. We also explore the benefit of early payment discounts from the vendors. In fact, I mentioned in response to one of the questions the initiatives that we're taking to try and mitigate the impact of input prices. And this EPD, early payment discount, is something that we are going to get this year as well. Our customers are also to a large extent insured as well. And now answering the later part of your question, so I think it's not about that if PDS has to do a write-off. Firstly, we haven't been experiencing any significant delinquencies. They are at a very, very small single-digit percentage. And so therefore, this is because of the careful approach when we do business with our customers. But therefore, it hasn't hurt us, and we believe we have suitable mechanism in place. But for any such unforeseen situation, if it arises, PDS would remain committed to honor its obligation to its vendors. I mean, it will always be our duty to clarify the risk to them. But if that unforeseen situation happens, I think we are committed to pay our vendors. To that extent, we will take the hit. But I also, while I've answered your question theoretically, I've also given you a practical on-ground situation wherein we don't have any meaningful delinquencies.
Thank you. Thank you so much for the clarification. Thank you so much. That's it from my side.
Thank you. Our next question is from the line of Mukul Agarwal from Param Capital. Please go ahead.
Yeah. Hi, Sanjay. Congratulations on an excellent set of numbers.
Thank you, Mukul. Thank you.
Yeah. So my question is, our aspiration and our guidance is to reach $2.5 billion in next 4 to 5 years, right?
Yes, please.
And considering some economies of scale kicking in at that level, is it too ambitious to expect like on a 20,000 crore top line, if we are able to achieve that 5 to 5.5% kind of PAT margin in 4 to 5 years?
I think this year we have achieved improvement in PAT margin from 2.4% last year to 3.3%, and we believe if we are en route to 2.5, every year we should get 50 to 75 basis point improvement in the PAT margin. So if I have to therefore mathematically add this delta that we would acquire, I think that possibility does exist, that we should be in that position when we are trying to handle the annual volume of business of 2.5, we should be closer to 5%. Yes.
So if we are able to do a 20,000 crore rupees top line in 4 to 5 years, a profit of 900 to 1,000 crore is achievable for a currently like 4,000 crore market cap company, right? With 40% plus ROC. And at that point, the ROC might shoot up to further more.
Yeah, that's what I think in terms of, I want allow me to restrict my answer to the top line that we are aiming at and the resultant impact.
Oh, sure.
So yes, yeah. So I think yes, yes, that.
These are my expectation and calculation. I just wanted whether it is possible or not. Yeah.
Yes, it is possible. I think that's what we have aspired to do. That is what we have tried to cover in our investor release. And therefore, if I, at the cost of repetition, if I try and answer the question again, a 50 to 70 basis point improvement year over year should enable us get 2%. So if we are getting to 20,000 crore, there is a potential of annual profit after tax of 900 to 1,000 crore in about 5 years from now.
Great. On this statement, I can just say, Amin, all the best.
Thank you. Thank you so much.
Yes.
Thank you. Our next question is from the line of Akshay Kothari from Envision Capital. Please go ahead.
Yeah, thanks for the opportunity. So I wanted to ask, like, freight costs are passed through for us, right?
Yes, when we do the FOB business, then there is no incurrence of freight cost for us. But when we do LDP business, yes, they are a pass-through, but they are a pass-through like if I've already contracted a given order, which get delivered over say 6 months, and in the meanwhile the freight costs have gone up, and then it cannot be a position of 100% pass-through. I also have to absorb a large part of it. That is where we mentioned in the beginning that we are gradually trying to minimize the LDP business and do FOB. And in FOB, there is no freight cost incurrence by me.
Yeah, I understand. So I'm sorry, I joined the call late. So can you give a sense like how much percentage would be FOB and the other one, CIF LVP business?
Yes, I can give you that number. I think last year we did about LDP orders in FY21 were approximately 423 crores, which were about approximately 7% of the sales. And in FY22, the LDP orders were about 1120 odd crores and about 12% plus of the total sales. So that's the answer to your question.
Okay. Thanks a lot.
It's almost about nearly 3 times increase in the LDP business in FY21 and FY22.
Okay. But this is recovering, so this is a part of our sales as well. Revenue.
Pardon me, I'm not sure if I get your question right, please.
So this is a part of our revenue as well, as we would be recovering from customers, right?
Yes, this is part of our revenue. You are right. Yes.
Okay. Thanks a lot. Yeah.
Thank you. Our next question is from the line of Mohammed Patel from Care Portfolio Managers. Please go ahead.
Thanks for the opportunity. So my question is that you said there was a 44 crore impact on EBITDA of investments which are going through P&L. So can you please throw some light on what this
Mr.
investment
Patel, I'm sorry, you're not clearly audible. If you're on a hands-free mode, please switch it to a handset and speak.
Okay, is it better?
Yes.
So my question is that you said there was a 44 crore impact on EBITDA of some investments which are going through P&L. So can you please throw some light on what these investments are and how does this P&L costs are expected to look like for next year?
So 44 crore, firstly, is the net of the revenue and expenses that has gone into doing the new business, investment to new business. So, for example, we did achieve about 300 crores of sales from the new business in FY22 and incurred a 44 crore loss. It's a gestation of the new businesses. Bulk of it were invested in the last 12 to 18 months. That's clarifying where the 44 crore number comes from. And on the second part, answering your question, typically our investments are under a guiding principle that am I getting into a new vertical which is bringing new customers on board, or am I getting into a new vertical which is getting a new category on board or new geography on board. These are some of the 3-4 main inspirations with which we invest. So some of the investments that we made in the last 12 to 18 months are on verticals to hasten our efforts to get more business out of US market. They are made to introduce home as a category into our offerings to our customer. They are being done to introduce accessories as a category to our customer as well. So these were our motivations of, and I mentioned earlier that we are looking at 500 crore plus sales to come from new businesses in this financial year and aspiring to a PBT break even. But answering the next part of your question, this is a like-to-like, apple-to-apple comparison, that investments we have made and how are they evolving into the top line and EBITDA or PBT contribution this year. So we are on a constant lookout for further committing investment into new businesses. So this would be a constant endeavor. That's one of the building blocks to the $2.5 billion journey. And we tried to clarify in the previous quarter investor release that the investment made should give us 2,000 crore of top line in about 4 years, PBT of 4%, and about ROC of 50 to 60% or so. So that's somewhere where we stand, that this 44 crore loss that we incurred on a like-to-like basis, these investments should not have any EBITDA loss incurrence in the current financial year.
Okay, that is helpful. My second question is, what is your outlook on freight costs for next year? So you mentioned that LDB is 12% of sales for FY22. What can this percentage be for the next year? Because US sales will increase.
Well, on a lighter note, it's anybody's guesswork where the freight costs are headed, given the China situation, lockdown. It is also the availability or the lack of availability of container, which also has an impact on these. But that's the macroeconomics around all of us. How I am trying to relatively insulate PDS P&L is to minimize the incidence of the freight costs by doing lesser LDP business, which I just clarified that LDP business in our portfolio is mainly because of the business to US market, which was about 25% of the total business last year. We're trying to bring it down to just, if I give you a broad aspiration, we have LDP should not be more than 10 to 15% of the business we do in US. That's where we stand in terms of mitigating the impact on our P&L.
Okay, that's it from my side. Thank you.
Thank you. Our next question is from the line of Sandeep Agarwal from Edelweiss Securities. Please go ahead.
Yeah, hi Sanjay. Thanks for answering all the questions in quite detail. I have just one small question. So when you do your business planning for next 3 to 5 years, right? So you will have some 10, 12 top clients who would be contributing substantial portion of the top lines and bottom lines, and then that list also will have 8 to 10 aspirational clients which you would be targeting via your strategy. And when you take those 20, 25 accounts which will be material for your next 3 to 5 years, and similar to what happened in tech outsourcing industry in 90s, if you see the growth came primarily from 2 areas. One, those clients themselves grew at a very phenomenal rate in last 20, 30 years, and also there was consistent shift of consistent shift in 2 areas. One, the MNC vendors which were servicing them got replaced by the outsourcing vendors, so that brought in a piece of growth. And then another piece of growth came in from completely outsourcing what their in-house teams were doing. So they got growth because of 1 plus 1 plus 1, 3 areas. One is the client themselves spending more on tech, which is a smaller portion of the overall growth. Second, replacing the MNC vendors, which was another big chunk of growth. And third, more outsourcing happening from in-house employees getting replaced. So similarly, when you see your 20, 25 clients, which may include current clients and aspirational clients, and you build your financial model or business model around them for next 3 to 5 years, how does that growth look? I'm not asking for a concrete number, but do you see that we will be on similar path how the tech industry evolved, or it is too early to comment in that direction? That is part 1 of my question. Part 2 of my question is that when you are doing this investment, which we talked about and which the previous participant asked question about, what are our key factors to decide where to invest, whether it is a strategic one, which means that you want to enter a new client or a new market or a new product line, or it is that you also put in a ISO font where you are looking at on one axis you are trying to measure the return on incremental investment, and on the other axis you are trying to optimize the return on management bandwidth which will go along with it. So if you have any thoughts on these 2 areas, will be very helpful. Thank you.
Yeah, thanks, Sandeep. I think these are important questions. On the first one, the business growth in the immediate term and over a static horizon of 3 to 5 years comes from entering a new geography, or in a given geography, doing business with a new customer. So therefore, for example, business with Coles is relatively new to us. We are building this relationship from strength to strength. A relationship with Walmart in US is TJ Maxx. These are new relationships which we believe there is tremendous potential for us to build up. Haynes is a new relationship, relatively new. We've been doing very small business, and we've got a $400 million annual business strategic sourcing contract with them. But that's like we are mapping the ecosystem around us. We are assessing that in the western part of the world, in US, how much of the consumption is happening in UK and EU, which are the clients we are serving, which are the clients we are not serving, and then given the internal credit risk assessment metrics, we make a short list and then we meaningfully engage to convert the engagement to a relationship. But the other important part is that with a given customer with whom we already have a relationship, and that's where I think some of the 2-3 pointers that you mentioned become important, is that the customer is growing on its own. I mean, COVID has seen consolidation in the retail customer end as well. So, so there are lesser and fewer retailers as compared to the pre-COVID scenario. So the existing retailers have become more stronger. So minimum I have to ensure is that I have to grow in line with my existing retail customers. And I'm not touching upon the key factors that PDS has built to arrive at this position of strength, wherein I can say with positive, approach that I will minimum grow in line. Second is I need to grow faster than the growth of my customer. So therefore, if my customer is, I'm doing only apparel as a category, can I now do a larger share of wallet with home as a category? Can I do accessories? That's where I'm trying to increase the share of the wallet. If the customer is focusing on the fact that e-commerce, and fast fashion are gaining more traction, then PDS global manufacturing sourcing footprint enables me cater to that need. That's where my 60+ factory network in Turkey becomes important to cater to the fast fashion need of my customer. So that's where I'm now trying to grow faster, than the customer. The third, an important reason is if the customer is evaluating a strategic shift into its conduct, that rather than the procurement teams sitting in-house, can I now let go to credible third parties? And that's where our engagement with Haynes translated into a strategic sourcing contract, and with S. Oliver, and I just touched upon a few more in the pipeline as well. So these are 1, 2, 3, in response to the first part of your question in terms of winning more customers in a geography, doing more business with more categories, and also if customer is pursuing e-commerce, then my global footprint caters that need, and then finally the strategic sourcing arrangement. That's answering the part 1. And the part 2 in terms of the channelizing the generation of cash into newer investment, I answered in response to a previous question the guiding principles of category, customer, or geography. But then you asked me a question on return on capital, versus the management bandwidth. I think return on capital, of course, the IRR or the payback are the eventual key financial metrics to make an investment decision, yes or no. But the second point to me is far more important on the management bandwidth. And the way the PDF model is organized, is that we are an aggregation of 40 verticals, wherein I have an independent, when I say independent, in terms of the operational independence, there are policies, guidelines, governance framework of PDS, but there is a team on ground who has incentive program in place in terms of a profit share. We're also aligned with the ESOP game plan on the whole. But given that we operate in this decentralized environment, and therefore when we look at making a new investment, then we also look at who is the entrepreneur or who is the employee stroke entrepreneur who's coming on board, who is going to take this investment ahead, who is also sufficiently incentivized. So therefore, with the model that PDS has been successfully practicing over all these years, management bandwidth is important, but PDS has been building it, augmenting it in a form and manner that this should not be relatively a constraint for us as we take our investment decisions ahead.
Thanks, Sanjay. Thanks for that detailed answer. Thank you and best of luck for current quarter.
Thank you.
Thank you. Our next question is from the line of Apurva Bahadur from Investec. Please go ahead.
Hey, hi sir. Thank you so much for the opportunity and congratulations on very strong results. So wanted to understand on this ESOP cost, which was 22 crores for this year. How should we factor this going ahead? What could be the recurring impacts of this, if there's anything?
I think whatever we have incurred in FY22, we believe there could be a similar incurrence in FY23 as well, and thereafter it should start coming down in year 2 and year 3 thereafter as well. So similar levels in FY23 and then gradually coming down. This is of course the assessment done as per Black-Scholes formula on as is where is basis. Yeah.
Okay, sir. Very, very helpful. So secondly, during the quarter, there was also a rise in other income. Was there any one-offs which was there which we should know of?
No, I don't think there were any one-offs. The only one-off was in the quarter 1 in terms of the monetization of real estate. Anything else has been recurring and in the normal course of business.
So why was there such a sharp rise in other income? What caused this?
I'm just requesting my colleague Reena Joseph to answer specifically what was in last year and what is in this year.
So Apurva, last year there was an impact of foreign exchange fluctuation, which was a negative impact, right? Which is not there in this year. So that's the reason why the quarter we are seeing a jump.
Okay. So last year had basically okay. Fair enough. Got your point. Sanjay sir, lastly, on the margin side, you have guided like a 50 to 70 basis increase on PAT margin front. But given the cost inflation that we're seeing generally in commodities, what would be the gross margin guidance, if you could help us with that?
Yeah, I think in the near term, quarter 1, quarter 2, the gross margin we will keep a close watch because of the factors we mentioned earlier, and any pressures on input we are anticipating they should kind of peak out by near of quarter 2. So that's where we are. So in the near term, we are a bit cautious at the gross margin level, and then that they should ease out then in the later part of the year.
Okay, sir. Thank you so much. Very helpful. All the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the floor back to Mr. Sanjay Jain for closing comments. Over to you, sir.
Thank you. Thank you so much everyone for joining us today, and it was indeed a pleasure to have an engaging audience like you to have joined our call, and we look forward to connecting with all of you again, and in the interim please stay safe. Thank you so much.
Thank you. On behalf of Edelweiss Securities, that concludes this conference. Thank you for joining us, and you may now disconnect.